This is Dan Sheridan, Sheridan Mentoring. It's Thursday, Nov 3. Yesterday, the Fed announcement came out. They raised the rates. Market plummeted yesterday after the announcement, down about 90 points in the SPX. And then today, we were down near 3,700, come back a little bit. We're at 37.36. So what to do? And for those of you like myself who think, okay, we've been through that. Okay, we could go back up, put credit spread. You think, well, I'm a little scared here. It's kind of dicey still here. Well, how do you hedge it? So we'll talk about hedging verticals today. So if you look here, here's an example in SPX where I'm looking at November 25, about 3 weeks out, selling the 35.40 puts. And hedging, buying the 35.20 puts. And we're currently around 37.35. So our short put is a couple hundred points out of the money. Now, as you do that, let me just see where it's trading at right now. Let's call it $3.80 credit. So 380 credit, it's 20 wide, the vertical. So you have $2,000 of risk, less your credit. What's that? $1,620 is your margin or your risk. And so you can see this is the expiration graph. This is where we're at now. This is the T plus zero curve. So the T plus zero curve, the graph today, doesn't look like the graph at expiration. What if we go down further? So with this, we have a little over $1,600 of capital, and we're about 2 deltas long on this. Now the yield's pretty good. I mean, at least at expiration. You know, you have a credit of $380 divided by $1,620, 23%. You know, I'd probably go after about 40% of that, which would probably translate it to about 7 or 8%. But what I want to get at is, you're putting up $1,600. You see the graph, you're 2 deltas long. What if I said, you know what? Hey, I'm willing to take less on the upside. I want to cut my risk on the downside. Well, I can add a vertical here, right? So if this is my vertical spread, sell one, buy one. This is a Nov 25 expiration. So if I'm selling the 35.40 and I'm buying the 35.20, good way to cut my risk in half, still give me a really good yield. Since this is 20 wide, this would be a hedge at the beginning of the position. I can buy one 35.50 put. So I'm buying a strike 10 points higher than the one I'm selling in the vertical spread. And then I'm going to sell one more. Of my short put. Now, what will be the cumulative effect by adding this hedge to the original vertical spread? You'll be left with, the fancy term would be a broken wing butterfly. So what you'll be left with is this. You'll be left with one 35.50 put All right, you'll be left with two 35-40 puts. Okay, and then you'll be left with one 35-20 put. So basically, you'll still have that original 20 wide credit spread, but we're adding a little protection, cuts our risk down, and our delta's in half, our risk down in half. We still make good money on the upside. And it looks like this. Right, so that's an idea of, hey, you're a little scared. Hey, a hedged put credit spread in this environment seems like a good idea if you're considering a put credit spread, have a little bit of bullish tinge, but you want to cut your risk down. All right, that's the idea for today. Thanks a lot.